Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Warner Brothers Discovery, stock is up 9% this morning right as market opens. There's some volatility here, up and down, so who knows where it will end by the time this video is over. Q4 earnings are out and they're okay, but I think it's the tone of the call, the guidance they're giving in certain areas that is driving the market reaction. Stock is up 31% in the past year as well. A lot of that is driven by some restructuring efforts they're taking within the company, more about reporting segments than anything else. They're focusing on streaming and studios on one side as a segment, and then global linear networks on the other side as a segment. Streaming and studios, obviously the exciting part of the business. There's growth potential there, margin expansion potential there. It's something akin to Netflix, and Netflix is a $400 billion plus business. This company is $28 billion, so obviously you can see why investors could be excited about something like that. On the other side, you've got the global linear networks, which is a business that's slowly shrinking. People are cutting the cord. It's impacting their networks, their advertising, etc. However, that business is still generating a ton of free cash flow, allowing them to pay down the debt that they have. This is a business that's 28 billion in market cap, but they do have 35 billion plus in debt. However, that's down from 50 billion when this reverse merger of Warner Brothers and Discovery happened. The stock was trading in the 20s at that point, so obviously longer term investors are not happy here, but shorter term investors are pretty happy if they were a buyer in the $8 to $9 range like I was. Made a couple of videos about it at that time. I do have longer dated options here, leaps for Warner Bros. Discovery. Happy with the results here, but wanted to look at them closely and see if the valuation still makes sense. So are these earnings actually good? You look at total revenues down 2%, the market expected minus 1%, EPS actually worse than the market expected. So why are we up 8%? Well, there's a couple of positives here. You look at the revenue, it's still moving in the right direction, minus 5% for the year, minus 2% for Q4 24. Adjusted EBITDA certainly moving in the right direction, negative 11% reduction in the full year. 10% bump for Q4 24. Free cash flow down 28% for the year, but this was expected. It's still a company that's 27 billion in market cap or whatever it is right now, producing 4.5 billion in free cash flow, down 28%, but that's because 23 had the strikes in there that meant lower content spend during a certain period of time and more free cash flow that they could use to pay down debt. Still generating free cash flow to pay down debt, still expected to generate free cash flow in 25 to pay down debt. You look at advertising, challenged, but some of the topics that were discussed during the call was Q1 actually looking pretty bright when it comes to advertising. So maybe they're seeing the light at the end of the tunnel with that advertising landscape being challenged. And you look at distribution, down 3% for the year, flat for Q4 24. That's a really good thing. This is the business that's been challenged in the past. That makes up a good portion of their revenue. They signed, I think, 5 affiliate deals with 5 of the 6 biggest cable companies in the US. And the important part of those is that they actually got affiliate fee increases when the market was expecting those fees to potentially go down. You lose the NBA, you lose a major sport like that, and you still are able to get higher fees from your cable partners for distribution for your channels. That's really solid. Sure, they had to throw in their ad-light subscription services to that, as they've done with a lot of the other cable companies, as have all the other major network companies. That's kind of the new norm, but it's nice to see that their distribution is kind of locked in for the next couple of years. And yes, the distribution revenue will probably still keep going down in the future as people cut the cord, but to get those fees locked in and even higher than before is a really important thing for investors and really, really good to see. Looking at the individual segments, studios struggled a bit for the year, down 5% on the revenue side, down 24% on the EBITDA side. Games was a problem for them in 23. They had Hogwarts Legacy, nothing that was close to that in 24, which drove some reduction in revenue in Q4 and for the full year, down 29% in Q4. They are realigning the whole strategy on the game side, closing a bunch of studios. I think the Warner Brother Games chief just retired not too long ago. Now they're focusing more on their marquee games. It's going to be DC, especially Batman, Game of Thrones, Harry Potter, etc. They're closing Monolith Studios, which was working on a Wonder Woman game, which is now canceled. Closing another studio, Player First Games, which they just acquired 7 months ago, which is crazy that they're doing that. I mean, this speaks to the somewhat high level of mismanagement that this company has had. It's like, make a decision, stick with it. Don't keep changing these strategies every couple of months. You're just acquiring a studio 7 months ago, now closing it entirely, focusing on other stuff. I think the games division has been a bit of a problem for them. Obviously, they've had a huge success with Hogwarts Legacy, but can they repeat something like that? Hard to tell, waiting for the next Harry Potter game. Theatrical struggled a bit in 2024, but as you look at 2025, you've got Superman coming up, you've got Minecraft, a couple of other movies. I think they're pretty positive about their content slate. I'm hopeful that Superman does well, because if it doesn't, it puts a big question mark on their DC releases in the future. Obviously, some of their TV releases in the DC universe have been huge successes, like The Penguin, but it remains to be seen how they do theatrically. However, they seem pretty positive, and their guidance for 2025, while not specific, was that they're going to see pretty decent growth on the EBITDA and revenue side in studios. And that's going to be needed to offset the continued lack of growth and decrease in growth on the network segment. And everybody knows that this is a melting ice cube. Revenues are down 5%, adjusted EBITDA down 10%. The question just becomes, how quickly is this going to melt? And there's a couple of nice things we heard from this earnings call. They signed those 5 deals with cable partners where affiliate fees actually went up. So it's nice to see that there's some semblance of reliability on the affiliate fees. Even if distribution will go down, it's going to be more based on people cutting the cord versus them having to cut those affiliate fees because they lost certain content, because they lost the NBA. It looks like advertising was pressured in Q4, but they talked about how there's signs of positivity going into Q1. So I think the takeaway from the call was that, yes, there was a reduction in revenue or a reduction in EBITDA, but it seems like 25 might look a bit better. They're probably going to still see a reduction in revenue. They're still probably going to see a reduction in EBITDA. But the hope from an investor's perspective is that this reduction starts to be offset by growth either in the studio segment or the direct-to-consumer segment. And this segment is looking pretty good. Surprising growth on the domestic subscriber side, 52.6 million in Q3 24 to 57.1 million in Q4 24. ARPU's coming down a little bit. Seems like people are either choosing the bundles or choosing the ad-supported service. International growth relatively slow, and ARPU is coming down a little bit there as well. So global ARPU is pressured. Average revenue per user. However, you're seeing pretty solid growth year over year. You're adding almost 20 million subs. Quarter over quarter, you're adding 6.4 million subs. That's really solid, probably a bit more than the market expected. And more importantly, you're moving into the positive direction when it comes to profitability. 103 million in adjusted EBITDA in 23, 677 million in 24. And the expectations for 25 are closer to 1.2, 1.3 billion. As far as growth goes, they're rolling out in more markets. They've got Australia coming up next. There's still the UK, Italy, Germany, bunch of solid, sizable markets that are going to help growth in the future. And they're still only in about 60% of the markets they're going to be in when they're a mature subscription business. So there's plenty of growth ahead. They talked about how by 2026, they expect to have 150 million global subscribers. They're getting this business into a profitable space. And the hope would be that when you look at 2025 results, you're seeing 1.2 billion adjusted EBITDA or more, growing that by $600 million. You're growing the studios by X million dollars as well. And that's more than offsetting the losses you're seeing in the network segment. That's what this business is going to be in the future. This is the future of this business. It's studios, it's streaming. That's why they have that new segment that's called Studios and Streaming. The future isn't linear networks, but the reality is linear networks is still needed in the meantime for the next 5 to 7 to 8 years to generate that free cash flow so that they could invest in growth, invest in paying down that debt that they have, and move on to the next stage of this company's life cycle, which is more of a streaming and studios business and less of a networks-focused business. So valuation and disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Right now, we're trading at 11.58. We got a market cap of 28.4 billion, a free cash flow yield based on the next 12 months of 15.4%. That's a significant re-rating from the 20% plus it was trading at just a couple of months ago. Enterprise value basis, you've got a 6.7% enterprise value yield on a free cash flow basis. People will say, well, this is, 6% of Netflix's market value. 14% of their enterprise value. What a deal. You have to remember though, Netflix is just a better business. That's the reality. When Netflix's direct to consumer business, their streaming business was in the 10 billion range, like Warner Brothers is, they were growing at 35%. Warner Brothers is growing at 2%. That's the reality. You have to set your expectations a lot lower than Netflix. That doesn't mean there's no upside, but the reality is that it has to do a lot better in terms of execution on the streaming side to really do what Netflix did. And right now they're very dependent on that networks business, which is shrinking, to generate that free cash flow to drive the growth in those other areas. That's why I'm seeing negative revenue growth for 25 all the way through 28, because the networks business keeps shrinking. The studios business and the streaming business, direct to consumer business, does grow, but it doesn't grow at a rapid clip. However, I think the adjusted EBITDA, the margin expansion in those areas of the business start to offset the losses in the networks business, and you see some growth on the free cash flow side. Towards the latter part of this period, I see them starting a buyback. They're going to keep paying down debt in 25, 26, 27. They do have $36 billion in debt. However, the rate on that debt is 4.7%. The average duration is 13 years. So I'm not too worried about that. They still generate a bunch of free cash flow. They're not dying anytime soon. And I think the market is re-rating this business on the basis of, hey, eventually this is going to be a different business than it is today. There's going to be streaming and studios on one side. They're likely going to spin off this networks business once they're done with the cash flow generation of that and they're happy with the health of the cash flow generations and self-sustainability of the studios and streaming business, and become a different business. This doesn't account for that, but it accounts for the overall business just being re-rated as it gets better, as it gets stronger. You look at the re-rating that's happened already. I have that down to a 12% free cash flow yield by 2029, maybe even conservative. With that in mind, though, I still get to an 8% return off of this price point. So if I'm targeting a 10% return, which I generally do, I get a fair value of 1060. If I'm targeting a 15% return, I get a fair value of 849. You can play around with these numbers, both of these numbers. If you say, hey, maybe in the future, once they pay down their debt, this should be a 7 to 8% free cash flow yield company. At an 8% free cash flow yield, a $60 billion market cap, you're looking at a 16% total return. Perfectly reasonable. I think it's achievable, but I just want to be realistic about where this business is today. I think in the future it looks a lot different than this did, and I think the market is starting to realize that. So I'm okay with holding this company at this price, but I wouldn't add. I already have a pretty sizable position via leaps, via long dated options, and I'm okay just sitting on those. I'll maybe roll those over into a further year once those become available. By the end of day, I think for me, this is one of those things where this is going to be a long-term play. You sit on it. Things may come up and down depending on individual years' results, but overall, as they continue to pay down debt, the market will re-rate the valuation from the enterprise value into the market cap. The stock price should go up as it has already. As interesting events happen, if there's any spin-offs, if there's any investments, if there's any stock buyback announcements, those could be positive things for Warner Brothers Discovery, but it's also a stock that could sit in the doldrums for a while, as it did for quite some time before it jumped up into the low teens, just because it's not a very exciting business. Stuff has to sort of play out. They have to grow that direct-to-consumer business, start generating free cash flow from that business, and start to offset the losses from the global linear networks business before the market really buys into that story. And it's starting to do so a little bit, but this is still a stock that's probably a bit underpriced in the long run. Like if it really gets re-rated into like a 7% free cash flow yield, this could be, a $30 stock pretty quickly a couple years down the line, which is why it's an interesting investment to me, which is why I hold leaps in it, because I can have a relatively sizable position without a ton of capital investment in a company that I believe in will do well in the long run, but I don't necessarily think will have massive movements in the short run, because this story has to play out. They have to separate these units. They have to show that these units are doing well on their own. They have to show that the streaming and studios unit is making up the losses in the global linear services unit, networks unit, and starting to actually outgrow the shrinkage that you're seeing on the other side. And I think that's going to happen. I think that's going to happen by like 26, and then the market will start to realize that this at $8 was an amazing value. At $10 to $11 is a pretty good value, and eventually send this into the high teens pretty quickly. So what do you think? Am I wrong about something here? Am I missing something here? Again, I understand that management here isn't amazing, but you're sort of buying in the bottoms here. You're buying in that area where when it was trading at 8, this company was like doomed. Like this company is going to die because it's trading at a 25% free cash flow yield. Now it's less exciting. It's not something I'd enter because, again, the valuation is okay, but it's a story that's going to take some time to play out, and there's a lot of market volatility. But if that volatility leads to the stock trading at $7 to $8 again, I'll buy more. That's my take on it. What do you think? Leave a comment down below. Like, subscribe, all of that good stuff. And as always, thanks for watching. Bye.